All right. So the question is, how do you exercise a call, right? And you're saying not how does it work, but like what button to press, right?
Right, to exercise it fully. We've already bought the call. It's in the money,
Hmm.
and we decide we want to keep buy 100 shares.
Yeah. So depending on the platform you use, like if you look at Robinhood, well, you're using Webull, but on Robinhood they have a button that says exercise. You hit exercise, and when you hit exercise, basically what needs to happen is that you need to have the money for the 100 shares. So if the 100 shares of the underlying stock costs 25K, if you have the 25K, you can go ahead and exercise. You'll get the shares, and that's it. You won't have the call anymore. You'll get the shares at the quoted price. So if the strike is $25 and the stock is at $60, you exercise, you get 100 shares at $25 per share, even though the stock is at 60.
Okay.
Yeah. So real simple. You just hit the button and it exercises it for you, swaps it out. You just have
If
to have the money.
if at any time, say the call expires, I don't know, December or whatever, and
Mhm.
you decide you want to, it's in the money now in October, could you exercise it at that point? I mean, do you have to wait till it's towards expiration, or when can you exercise it?
Great question. Nope. You can exercise it as soon as you buy it. If you bought something that was in the money and you wanted to exit, yeah, I don't know why you would do that, but if you bought it and it was already in the money, you can exercise it immediately.
Okay.
Yep. So you don't have to wait until the expiration date. Um, yeah, you don't have to do any of that. It's whenever you're ready, you have until that end date to go ahead and exercise if it's in the money.
Okay.
Yep.
Thank you.
No problem. All righty. Sorry, I'm in front of a police station. But all right, the basics of covered calls. So covered calls, covered puts. These are, I would say, one of the safest. Well, for covered calls, covered puts, it's on the risky side. I wouldn't do it. But as far as covered calls, this is one of the safest way to guarantee profits. The profits are capped, but well, not but the profits are capped, and it costs more money to run covered calls. The reason why it costs more money to run covered calls is because you need 100 shares of the stock. To buy just a normal call, you don't need anything. You can buy any call on any company, as long as your brokerage will allow it, and you don't need to have anything to qualify to actually buy the call. Now, when you're buying covered calls, if you want to, well, I'm saying it as the buyer. All right, let me back it up. Covered calls. When you're using covered calls, let me stop saying buy because you're not buying covered calls. When you're performing the act of selling a covered call, you need 100 shares of the stock. So a covered call is pretty much what you get to do once you have 100 shares of the stock. So the 100 shares of the stock is going to become collateral, and then you can sell one call per 100 shares. So if you had 200 shares of a stock, you could sell two covered calls up to expiration. Any questions? Oh, Yvonne.
Okay. I just wanted to ensure, because I thought once you had 100 shares, you could do the 100 shares as a covered call, but you can only do one of 100 shares.
Right. Yep. Yep. It's per 100 shares. Like if you go to buy a, let me see, I have an example here. Uh, yep. We have an example here. So if you go to buy, so in this example, an investor buys 100 shares of the stock, right? And you can sell one call option for each bundle of 100 shares right there. I can zoom in on this. Here you go. So if you buy 100 shares of the stock, you can sell one call option for each bundle of 100 shares. So again, if you have 200 shares, now you can sell 2. That's why when you go to buy a call option that's not, you're not doing any covered calls or anything like that, just a normal call option, you'll see the how it's presented. It'll look like $3 when it's really $300 because you're multiplying it times 100, because that 100 is the shares that was used as collateral to actually put the call on the market. Does that make sense, Siobhan?
Yes.
Yeah. So every bundle of 100, you get to sell one call option. So this puts us on the seller side. Instead of just being a consumer and a buyer, we can actually, play on the other side of the fence. And actually, this side is better if you ask me. It's safer. And then time decay actually works for you. So what was that? Last week or last, in session 2, we talked about time decay and how it works. So time decay works against you when you buy a call, right? When you're buying just normal call options, you're just swing trading, day trading, whatever. It works against you because the rate of decay is getting closer to the expiration. But when you're selling calls, it works for you because you want your option that somebody bought to expire worthless. You don't want them to exercise it, because if they exercise it, it goes in the money, and they exercise it, they're going to take your 100 shares, but you get the money in exchange. All right, let's just read some terminology real quick. All right, so I gave you a brief overview. We can talk about key takeaways really quick. So a covered call is a popular option strategy that's used to generate income for investors who think the stock prices are unlikely to rise much further in the near term. Okay, this is one of those things that you have to really wrap your head around. So when you're doing covered calls, and I know when we learned about calls, you always thought that the stock was going up and it has something to do with the stock going up. A covered call does not. So a covered call is when you think that the stock is getting close to a ceiling. So let's say you set your support for a stock. Let's say the stock is $10. I'm sorry, I said support. You set your resistance at $15. The stock is at 10. The stock moves up to 12, 13, and around 13, okay, it's going to go up. It has $2 more to hit 15. Once it hits 15, it's probably going to reject. When you're getting close to resistance, you can sell a covered call because people will buy that call thinking that it's actually going to go beyond. So when you set up your covered call, you can set if 15 is your resistance, you can sell a 17, right? You can sell a 17, 18, 19, whatever. But you sell it above resistance, because then if they go and buy the call, they're thinking, okay, to be in the money, I just needed to go to 17. But when you look at your chart, you see, okay, 15 is where it's going to reject it, which is perfect for you, because once they buy it, it rejects. Time decay starts to work for you. The longer it does not reach that actual strike, the better it works out for you. And then also you need it to happen with the date. So a lot of people like to use a weekly date. A lot of people won't use a month, 6 months, 12. Like, they don't want to set it out that far because they don't want to have to wait that long to receive the money. Are y'all following me so far?
Yes.
Perfect. All right. Next thing, a covered call is constructed by holding a long position in a stock and then selling and writing call option on the same asset representing the same size as the underlying long position. So this is pretty much what we talked about before. You're holding 100 shares of the stock, then you can sell. This is where terminology flips again, sell or write. So if your platform says write a call or sell a call, make sure you understand what is referring to. But you're selling the call or writing the call for the same option. You're selling the call option for the same asset that you have an underlying long position in. So again, 100 shares of a stock allows you to sell calls. All right. A covered call will limit the investor's potential upside profit and may not offer much protection if the stock drops. So again, same thing. We're playing a game of keep away. You write the covered call. It's a capped upside. Like, you can't make, you can't turn $10 into $1 million with covered calls, but the game is set up for you to win with covered calls, right? So if it gets exercised, you pick the strike that was higher than the underlying stock price, right? So if it gets exercised, you're going to get more back than what you initially invested. But then if it doesn't reach that that strike price to where it's exercisable, now you just get to keep all the money and you get to keep the shares. So that's what you want to think about. Setting up cover calls. I'm playing the game of keep away. I don't want to set my strike too low, because if it actually hits and it goes in the money, they're going to exercise on me. And when they exercise on me, they're going to take my shares. We don't want that to happen. We want to keep the shares and we want to keep the money. And
When does it
oh, go ahead.
when does it like expire, when it's like worthless? Like when you set it up and no one wants to act on it and you don't gain any money off of it?
Like no one actually picks up the call. Like you
Right.
put a covered call into the market and no one buys it.
Yes.
You need to tweak your strike.
Mm-hmm.
And you probably need to tweak the date, because if it's unrealistic, people are not going to buy it. Like if it's a $10 stock and you set a $35 strike and it expires in like a week, nobody's buying it.
Okay.
It has to be something to where you got to make it. You got to put some bait on the hook for the fish, right? They have to look at it and say, this is possible. And another way to figure out what's possible is, before you set up your covered calls, just look at the normal calls. Look at the normal calls, look at how much volume they have, and look at how much open interest they have. So if you're looking at a call, it has a lot of volume, a lot of open interest. That means that if you go to sell that same type of call, it's probably going to get bought immediately. Just make sure that you're not selling the call for something that's actually going to happen. That's the tricky part. Does that help, Michelle?
Yes, it does. Thank you.
Cool. All right. Call seller will sell the shares at the strike price and keep the premium if the covered call exercise. Yep, we already talked about that. How it works, we talked about that. Let's get into an example. All right. In the chart below, the horizontal line is the security's price at expiration. The vertical line is the profit or loss potential. You can hover over. All right, they're just giving us instructions. All right. See if we can figure this one out. Example of a covered call option strategy. The scenario, let me zoom in. So can y'all see this? Is it too zoomed in? Oh, no, it looks good. All right. An investor buys 100 shares of stock and simultaneously sells one call option for each 100 shares. The premium collected from selling the call, $3 per share, totaling $300, provides some downside protection while limiting potential gains if the stock price rises above the call's strike price. The stock price profit loss without the cover call strategy is also given with the dotted line. All right, so let's try to figure this one out. All right, so basically someone's selling one call. The premium collected from selling the call, which would be $300. Wait, the premium collected from selling the call, $3 per share. Yeah, $300 provides some downside protection while limiting potential gains if it rises above the stock price. All right, so looking at this chart, this is the break even. Oh, it's actually interactive. Oh, this is cool. All right, so this is the break even at expiration. This is the break even means like nothing happens. This is the net profit, and you can see that we'll be at $3 if we're at this price point. If it goes to 100, the maximum profit is 110 at expiration. And wait, I'm not understanding this. Oh, the net profit. Okay, yeah. Net profit is 110. The loss would be $13. So pretty much what this is showing is the capped gains. You can see that once you get to max profit at expiration, it tables off. So even if it was just to keep going, you're not going to see any crazy spike in price, just like you would see with a call. So pretty much the covered call already has its profit ceiling built in, and you just have to pretty much wait the time. What you need to do first is to figure out, okay, where don't I need to go? The second thing is how much, and you also have calculators. That's another thing. You've probably seen this type of calculator in your on your platform. I know Robinhood and Fidelity has one. And so when you're picking your what is it called? Your option strategy, you can pick a covered call option strategy to give you a setup just like this. And then when you're picking your strike, when you're picking your expiration, it'll show you, okay, this is what it looks like, so on and so forth. All right. Again, great way to make some easy money, but be careful in a bull market. In a bull market, anything can happen. But short expirations can protect you from that. If you're going into month-long expirations and you only have one contract, it may get a little boring because you're waiting for a month for just one trade. If you do it every week, it's more thrilling, but then you also have to be on your toes because it could pop. Somebody could exercise, and then now you just have money. Which again, covered calls, you win on either side. If it goes into an exercisable situation, you get to keep the cash. If not, you get to keep the cash and the shares. But yeah, that's what this is saying. Pretty much that after a certain point, profits are just going to be profits. It's just going to table off. All right. Let's go down to profiting from covered calls. All right. Oh, best time to use covered calls. This is going to be good. All right. So the buyer pays the seller of the call option a premium. So again, the seller is the person who's selling the call. So you got 100 shares of the underlying stock. The buyer is going to buy it from you. And then again, they're just buying an option. So it's the same setup. It's not, there's an obligation, but not a right. Let me see. Oh, sorry, lost my train of thought. The premium is a cash fee paid on the day the option is sold, and the seller's money to keep regardless of whether the option is exercised. All right. Thus, a covered call is the most profitable. This is an important part right here. A covered call is most profitable if the stock rises to the strike price, generating profit for the long stock position. So covered calls can expire worthless unless the buyer expects the price to continue rising and exercises, allowing the call writer to collect the entire premium from its sale. So again, this is basically a backwards way of saying that either way it goes, you win. That's what this is. That's what both of these are saying. So someone's going to buy the contract from you, and regardless of what happens, you win. Again, if I bought 100 shares of a stock at $100 and I set a strike for 110, 115, 120, and it actually goes there and someone exercises on me, that's fine because now I get the profit of the share appreciation. Now, if it doesn't go there and expire worthless, I get to keep the money in the shares. So again, profiting from covered call, this is just a long way of telling you you're going to make money either way. Let's see, the call seller will sell the shares at the strike price and keep the premium if the call exercises the right profit from the difference they paid. All right, yep. However, the seller gives up the chance to profit further. The share price is increased by selling the share at the strike price. Yeah, we already talked about that. All right, best time to use a covered call. Covered calls can be excellent tools for improving your returns, but they are best for specific market conditions and investor outlooks. All right, so these are 3 ideal times to consider using the covered call. All right, so the market is neutral or slightly bullish, which today the market was what, flat? So this today would count as a neutral day. All right, cover calls are best done in a neutral or slightly bullish market environment where you expect the stock price to stay relatively stable or rise modestly. All right, we can skip all the extra stuff. Let's see. All right, so if the stock price does not rise slightly but stays below the strike price, you keep both the premium and your stock. So this is what I've been saying the whole time. They're just, I don't know, walking us around a long way. Any questions about this? I just want to make sure we understand how the covered call work. Again, it's pretty simple. This is just filler information, but it's good to know just in case you get you see a market and it's doing one of these two things. Any questions about covered calls so far? Cool, cool, cool. All right. Excuse me. All right. Back to what we were saying. So if the stock price rises slightly but stays below the strike price, so again, it's going up, it stays below your strike price, you get to keep both the premium and the stock. So you keep the money, keep the stock. And then benefiting from a steady stream of income without sacrificing your shares. This is the whole reason to do it. If you don't remember anything else, remember this. You get to keep the other person's money and you get to keep the stocks. Michelle?
Okay, so in this scenario, this is like when someone has chosen to say, hey, yes, I want to buy your contract if it reaches that price point.
If someone wants to, so run me the scenario again. You're selling a covered call, you put it
Right.
into the market. Did they actually buy it?
No.
Okay. This situation is if they bought it.
Right. Okay.
So if
So
they
this
bought
is
it,
for if they buy it. Okay.
yeah, if they buy it, you get to keep the money and the stock as long as the price can go up. It's fine as long as it stays below the strike price.
Okay. I got it now.
Is that
Thank you. Yeah.
okay? Your situation was if they're thinking about buying it. Is that
No, that was what I wanted to know because, like, I want to make sure that, like you said, I keep things in line so that we're still playing the game of keep away, but not that it's so far out of reach that no one would ever make that purchase of it so that it expires worthless. So that's what I want to avoid.
right? Another thing to notice too is like when we have earnings, if you ever notice, a company will go into earnings. Let's say we have $100 stock going into earnings, and people are buying calls on it, right? They're buying bets that is going to go up. And let's say somebody bought a 135 call, 135 strike for a call. And let's say when the stock actually prints the earnings, the stock only goes up to 115. That 135 call that they just bought the next day is probably going to go down and be not out of the money because it was never in the money, but it's probably going to go in the negative because what people are noticing is that the event that was going to send it, potentially to 135 is no longer going to happen. So that means that the value of that contract goes down. So no one wants it after
Okay.
the event happens. So yeah, the market, it has a brain of its own. So if you set in your strike out too far, not gonna buy it. Have you ran into that situation before?
Yes. 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 So, I
You
mean,
try to, huh?
I was saying I had a
But
bunch of energy transfer at one time, and then I kept like putting my premiums out there for something which was far off, and it was like 10 or 14, and then it was finally executed when the stock started to go up, and I didn't want that to happen. Even though I did make a little bit of money on it, it continued to increase. So I just wanted to know what I did wrong so I don't keep doing that.
Yeah, you made money though, right?
I did. I did.
But they exercised on you.
Yes, and I didn't want that.
Oh yeah, yep. You said it. So yeah, you probably set your strike too close.
Mhm.
What was how long was the expiration out for? Did you have like a month, a week?
I think it was like a month, and I was just trying to do it just to earn $4, because it was going to be like a $4 earning, and I'm like, okay, well, that's a free $4 that I wouldn't have before, but yes. So then some of the stuff that I would set out would be so unrealistic that no one would ever make that purchase, so I wouldn't get the $4 premium. And then, so I wasn't winning whenever I was doing the covered contract. So that's what I want to avoid. Setting something so unrealistic. I have to make it, like you said, where they want to buy it.
Yep, they want to buy it, and it doesn't. So like what I would do is look at high RSIs, look at like if a stock that you're looking at selling covered calls on has a high RSI or a high stochastics RSI. I would look at those. And if they're getting close to resistance, like if they're maxed out, like if you're like, we just looked at some stocks that had 80 RSIs on the day, right?
Right.
Those are ones I would potentially look at covered calls on, because people are looking like, okay, cool, it's up this high, but some people don't care about RSIs and, you know, technicals. They think that it just can keep running. So as long as if you're selling one contract, you just need one sucker to buy it and you're good to go.
Right. Okay. Thank you.
No
Well,
problem.
Darius, for when you remember when NVIDIA was having their earnings and you knew that it was going to go down?
Yep.
I know some people, that's exactly what they did. They did a covered call because all these other folks that didn't know any better are going to think, oh, it's NVIDIA, it's going to go up after earnings, and they bought and held during earnings. They just did a covered call knowing it was going to probably go down. And then they just made money that way, covering the call.
Yep. You can play earnings, with covered calls, because again, it's a win-win. If you go and you hit that strike, cool. But if you don't, perfect. I get to keep your money and my shares.
Yeah. And it was safe because they did it so far away that people were thinking, oh man, this thing is going to just explode. It was far enough away that it probably wasn't going to get there anyway. And it went the other direction.
Yep. So yeah, again, it's a lot of ways to play the market. That's why I'm glad we're going through these different ways to play options. But yeah, it's a lot that you can do versus just buying calls and puts, just your normal calls and puts. That's why later on in later sessions, we will talk about combination strategies to where you're mixing calls, puts, and, you know, doing debit credits and things like that. But yeah, good way to make easy money. This is one of the easiest option trades that you can do. But on the other side, you need a lot of shares.
Right now, we're just doing what's called naked calls and puts. Is that the technical term?
Yes.
Okay.
Yep. Just naked calls and puts. No covered calls. Well, Michelle, she's practicing covered calls. I may look at it. I have to find something I really like. Affirm was one of the stocks that I was thinking about doing it on. But I have to really find something that I like. That's not too much. Like the stocks I like sometimes are like 500 a share. And yeah, I'm not doing that for covered calls. Not right now. I'm not. Maybe in the future. But all right. So we talked.
And you said you was going to go over credit spreads at some point, or
Yep, debit and credit spreads. Yep. You said what now, Yvonne? Your mic went out.
Oh no, I was saying thank you.
Oh yeah, yep. No problem. All right. Number 2, when you want to generate income from existing holdings. So if you want to generate additional income without selling your stock, covered calls are a good choice. This strategy allows you to collect premiums on the call option sold. It can be particularly attractive for investors who are holding the stock long term and want to boost their income. All right. Same thing that they just repeated in the first, these 2 paragraphs, but they just put it in a different way. So if you're holding a long position, right? Let's say you're holding Microsoft and you've been holding it for the last 5 years. You have 100 shares. You don't really want to sell it because you're not trying to trigger like a tax event, but you do want to make some money. What you can do is go ahead and start selling those covered calls and just position it in the right way to where you're going to make your money and you're not going to get exercised on. So this also goes into, like, a lot of people come into trading and they ask me, what's the point of buying 100 shares of stock? Why would I just buy 100 shares of a company just because? Well, over time, you can, let's say again, you have a 5-year time horizon and you're looking at a company like Microsoft. The share is about $400 a share. Over 5 years, you can get, it's people that can buy 100 shares in 1 year, in 1 week. But depending on how you set it up and how much money you want to allocate to one position, eventually down the line, once you finally get to 100 shares, then you can go ahead and take advantage of the strategy and sell covered calls. So again, I know a lot of people that have been trading. I met a guy at a baby shower once. He had 800 shares of NVIDIA, and he would sell covered calls because he was just like, I'm not selling the shares themselves, but I will sell some calls. So I think that was a smart thing to do. So it's always something you can do regardless of where you go in the stock market. All right, number 3. When you're willing to sell the stock at a target price. All right, so a cover call can also be effective when you want to sell your stock at a prearranged price. By setting the strike price at or near your target selling price, you collect a premium up front and stand ready to sell your shares when the price reaches your desired level. So this can be particularly beneficial if you want to exit a position gradually, or if you want to take advantage of a specific price target. The call premium is a bonus if the stock is called away, adding to your overall return. Even if the stock doesn't reach the strike price, the premium earned provides a partial return on your investment. So yeah, same thing. If you just want to get rid of something, you can just set the strike to where it's going to hit eventually. Add enough time to the contract itself. Once it hits, you make the price. You're going to get exercised on, but you keep the premium that you made from it actually going up. So again, same $100 stock, you set a 150 strike and you kick it out for, I don't know, 6 months to a year, and it eventually hits, it's going to go ahead and kick you out, and you're taking a profit. So this is another way of thinking about how to set up your covered calls. When you know, like, okay, I'm not going to hold this forever. I want to get out, but I want to get out at a nice price, in bundles of 100, right? So if you're holding, I don't know, 600 shares or something, you want to get out, you only want to sell 200 shares. Okay, I'll sell 200 shares at 150. The stock is at 100. I'll let it run. Don't worry about it. Once it sells, I make the premium. I'm good. Y'all follow me on that one? Are we good?
Yes, I'm good.
Cool. All right. Now, when to avoid using a cover call strategy. All right. Everything is good until it's not, right? No perfect strategies in the market. All right, so let's talk about when to avoid using the cover call strategy. All right, when you expect a significant upward movement in the stock price, we don't even have to read all of this. If it's going to be in a strong bullish trend, you can either just wait, or you're going to have to kick that strike price all the way out. So it's like for people who were when NVIDIA first started going on this run, for people who were writing cover calls, it was just like you're just getting exercised on every single time. Every single time you probably got exercised on with NVIDIA, unless you had a really, really short date and you got NVIDIA on a downtrend. But yeah, upward movement in the overall market, probably something you don't want, especially if it's going crazy. Like Jerome Powell just said, he just came in and saved the day. Market is going crazy. Yeah, probably not that time. Again, this goes back to where they said you want neutral or slightly bullish in the market. So the market is normally neutral or slightly bullish when the market is at its peak, when it's at its top, when the SPY has reached all-time highs, which it keeps doing. It reached all-time highs and it's starting to stutter, right? You look at the daily, you look at the week, and it's kind of stuck and just hovering there, trading sideways. That's a good time to play those calls. And again, that's the opposite of significant movement to the upside. So good point here. All right, second one, which kind of is the same thing when the market volatility is high, but volatility can be a pop up or down. So let's read this one. High market volatility can pose a significant risk to covered call strategies. Stock prices can swing wildly, increasing the likelihood that the call options you sell will be exercised unexpectedly. In addition, in a volatile market, the premiums on call options tend to be higher, which may seem attractive. So from this paragraph right here, when the market is volatile, the implied volatility on those contracts is going to be spiking, right? So you're going to see like, oh, okay, normally I would make $4 premium off of this contract, but now that the market is volatile, I can make $16 premium per, per call. That could be bait. You could go for it, and then boom, it pops. You get exercised on, right? So again, this still goes back to that same point. High market volatility, significant bull market. You just want slow and steady. You want the market to already get the run out of its system, and then you can go ahead and sell your calls. Next paragraph. However, the underlying risk of abrupt price movements means you could be forced to sell your shares at a lower price than expected or suffer a loss if the stock declines significantly. If the stock price falls sharply, the premium collected may not be enough to offset the loss of the underlying stock, resulting in an unfavorable outcome. A covered call might not provide adequate risk management in such environments, and alternate strategies could be considered. So this is when you get a situation like we had, what was that, 2 months ago, where or people thought the world was over. The market was just bleeding and bleeding for it was like a week straight, I want to say, just red after red after red. At that point, the shares that you hold are down by so much that even if the covered call works out for you, the shares are tanking. Right? Like the shares are that you're losing so much on the shares that the covered call, whatever it's doing, doesn't even matter at this point, because the shares that you have, you're already taking a massive loss on it. Does that make sense to y'all?
Yes.
Okay, cool. All right. That's a great point. All right, so this is another example. We actually have two scenarios. Perfect. So we got a bull scenario and a bear scenario. All right. Let's see if we can, let's read this first. Assume you buy XYZ stock for $50 per share, believing it will rise to 60 within 1 year. So it'll pop $10 in 1 year. You're also willing to sell at 55 within 6 months, giving up further upside while taking a short-term profit. Selling a covered call on the position might be an attractive strategy in this scenario. All right. So the stock option change indicates that selling a 55 6-month call option will cost the buyer a $4 per share premium. You can sell the option against the shares that you bought at 50 and hope to sell at 60 within the year. So when you write this covered call, it creates an obligation to sell the shares at 55 if the underlying price reaches that level. You get to keep the $4 in premium plus the 55 from the share sale for a total of 59 or 18% return over 6 months. But you'll wait. Oh, okay. I see what you're saying. All right. But yeah, you'll get a $10 loss on the position if the stock falls to $40. Buyer won't exercise the option because they can buy the stock at a cheaper price. However, you'll keep the $4 premium from the sale of the call, reducing the total loss from 10 to 6. So again, this is the same. These two scenarios just combine what we just talked about. Selling the covered call works, but then if the market just implodes, then you could lose on the actual share, the set of 100 shares that you're using to sell the covered call. So you still need that to be a little stable, because if not, you're going to be losing so much on the shares that the premium is just going to be a discount. Not going to be enough to save you. All right, so let's look at these two scenarios. We have a bullish scenario where the shares rise to 60 and the option is exercised. So January 1st, we buy the shares for $50 a share. And then the same day, we're going to sell a call option for $4 that expires June 30th and it's exercisable at 55. So this means that we set up we're selling a call for $4 or $400. It expires June 30th and the strike is 55. So June 30th comes around, stock closes at 60. The option is exercised because it is above $55 and you receive 55 for your shares. So the same shares that you bought on January 1st, you paid $50 for. You also sold the call option for $4, so you get to keep the $4. And then once you sell it, you keep you receive 55 for your shares that you paid for 50. So everything works out in your favor in this bullish scenario. July 1st, you profit $5 capital gain plus $4 premium collected from the sale. You profit $9 per share or 18%. So in this situation, it works. It works how we've been talking. You buy the shares, you sell it to someone, it expires, but then they exercise it. They exercised it, so you don't get to keep everything. If they exercise it, you keep the money, and you're scot-free. No shares are left over. Any questions about this one? Take silence as a thumbs up. All right, cool. Bear scenario, and this would be the last one. We're a little bit over time, but that's okay. All right, bear scenario. So shares drop to $40 and the option is not exercised. All right, so on January 1st, we buy shares for $50. Same day, we're selling the call option. Same thing for the $4. It expires on the 30th, exercisable at 55. Same setup. This time, June 30th, the stock closes at $40. The option is not exercised and it expires worthless because the stock is below the strike price. The option buyer has no incentive to pay the $55 per share when they can purchase the stock at $40. So on July 1st, what happens is that the shares you bought up here for $50, you take a loss of $10 per share. The $4 premium collected from the sale of the option, which will give you $6 or a 12% loss. So you still lost money. The premium kind of helped buffer you, buffer the loss, but you still had a 12% loss because the stock went down too much to where the shares that you bought took a hit. This is just another example. All right, let's talk about the advantages and disadvantages. And then I think we should be good. This just goes into the advantages and disadvantages. What we'll do is we'll open up the next session with covered puts. Again, a put, well, we'll talk about that in a second. Let's cover this first. All right, pros. So they generate immediate income, offer some downside protection, can improve existing holdings, and flexible and adjustable. All good things. Cons, limited upside potential, which sometimes that's good. Doesn't fully protect against downside losses, like we just saw in that example with the $40 drop. Also requires stock ownership, and then option trading involves transactions cost. So there's a lot of ways to lose money, but there's a lot of ways to make money as well. And if you do it the right way, you should be good to go. If we talk about, let's switch over to puts real quick. So a covered put pretty much, instead of being, and I'll add these to the Discord, but so for a covered put, what pretty much happens is that you will get assigned shares, right? So a lot of people, when they're using covered puts, if they're not going to short, they're using the put to actually buy shares of the stock. So when you're using the put, if the shares actually go the opposite way of the price that you need them to go, you can be assigned the shares. So it will force you to buy the shares at whatever price that's quoted on the strike. So that's why I don't want to be forced to buy anything. That's why I don't play with covered puts at all, because I'm not being assigned 100 shares of anything unless I want to buy it. Now, again, if you just want to buy something that's going down, sure, you can do it this way. But I think it's better to just DCA dollar cost average and just buy it slowly on the way down. But if it's your first time looking at covered calls and covered puts, I recommend going with covered calls, safer, slower. We're also in a bull market, and so you can play it again once the market is peaking, it's topside. Set up your covered calls, find your resistance, make sure everything else is maxed out, and you should be good to go. Any questions before I stop this recording? Boom. All right. Silence is a thumbs up.